So, from the absolute basics to now stepping into the shoes of a beginner technical analyst. I mentioned that price leaves a trace, and that trace is something that we can work with. We can extract information about or from what price did in the past, and due to at least partially the cyclicality of things, we can expect to a certain degree that something will happen in the future again, or there is at least a likelihood, some likelihood that something may happen in the future. This game really is about probabilities, and I want to go deeper into that at a later stage, but just know that things are cyclical, and just ask yourself whether or not that may be true for trading, for asset prices, and for the human behavior that drives these asset prices, if that is also true. I'll leave that one up to you guys for now. So once again, as usual, slides. Let's go. Just a tiny bit of slides. A tiny few is not proper English. Anyway, beginner concepts. There we are. So what we're going to look at today is mainly patterns. And I want to already give you some perspective about, okay, first let me start with this. We have price action. That's generally just price doing its thing, right? Studying price as it is right now, right here. Then looking at how price behaved in the past, etc. But especially how price is behaving at this very moment. You can already, once you get more advanced, more experienced, you kind of start with price, and then you work your way to patterns, indicators, etc. And then as you get more advanced, I think, or at least, well, that was my journey, and I think I've seen other traders do that as well. You end up back with price, and I'll try to explain in a second why that is. But we're going to look at patterns because we cannot go around that. That's a part of technical analysis. We are going to look at indicators a little bit, and then I want to come back to candlesticks, which closely are related to sort of price action trading styles. Perspectives, not yet. Maybe I should change that slide. Huh? How about that? Let's go to the TDFA my way to my browser. Support and resistance, I talked about that a little bit already. This goes deeper into that, and it is just one of the most important concepts in technical analysis to understand where an asset may be desirable and where an asset may not be so desirable, right? It's really supply and demand. There comes a price point for an asset where people are going to find something very cheap. It's the same as any product on any fruit market that you may find, or if the crowd vat all of a sudden has some sort of diaper offer, that's something I'm looking at these days. You can bet that if they, for example, if diapers always cost €5 for a pack, they don't. They're more expensive, but well, depending on the pack. Anyway, if like a certain amount of diapers always cost €5, and all of a sudden they lower the price to 1, well, you can bet that people are going to storm to that store. I don't know if you've ever seen a store that is closing down, the store that nobody ever visited, but then they put down closing sale or whatever. All of a sudden it's like mega busy, right? And then the products will sell. So there's a lot of buyers for that asset when the asset is sort of like really undervalued or labeled cheap, right? And so this support, like supply and demand, is what we want to try to get a grip of, and we can name that support and resistance. So when price reaches a certain resistance level, so a ceiling, and when we know that at a certain price levels, people are going to be buying the asset, or at least, again, there is a probability that people are going to be buying that asset. And we call this support and resistance. Very, very, very important concept. And this, just by looking at this and understanding this properly, you've already got some edge on, the vast majority of people that enter markets and are buying and selling assets, if you really, really understand this. I mentioned already chart patterns, so I'll have my own view on this in a second on our trading view chart. Just know that this exists, and there is definitely, I mean, this has been studied, right? There's people like with a lot of money who hire people to study this stuff and determine the probability of these things actually, coming to fruition, being true, if you will. We will get into this a little bit deeper. I use them as well. I just take them as one of the puzzle pieces for coming to a certain trade or investment decision, right? I don't, the same with, remember that like the PE ratio, you don't only use the PE ratio. You try to look for multiple signals, and multiple signals coming together is what we call confluence. I think I mentioned that word before, but confluence is absolutely essential, and we're going to hear more about that. We're going to hear about that more and more and more. Okay. Moving averages. So this is really quite interesting. A lot of automated trading strategy. It's a video from Interactive Broker. Sorry, it's a good one. And I think, watch the video. It becomes clear over there, and I will also show it on the chart in a second. Right. So Interactive Brokers, they've got their own video. I think we use Fibs at a later stage as well. Price action trading. Okay, this is a good moment where, not yet. No, I'm not going to switch yet. So price action trading strategies, so really mastering price. And that is my ultimate advice for anybody that wants to start trading. Look at price, study price, master price. If you master price action, you master markets. It's really, that's not that simple, but that's the gist of it. And I will explain in a second why that is. What is this? Not sure. Here we go. So we have patterns and indicators, remember. And I can just best show you in the browser in a second, but this is a good source on what indicators are, how they work, etc. Maybe they even explain it better, or maybe they explain it better than I do. But just know that these we have, and I'll just show you in a second what they are, right? So read through them and try to understand both patterns and indicators. Speaking of indicators, Fidelity, huge firm. Huge asset managers are one of the big, top three, I think, the top three. Sorry, pardon me, not entirely sure. But they have this indicator library. And if you click on Bollinger Bands, for example, is one of the basic ones that you find. It explains what it is. It's a great library. And it actually, it can give you some idea for strategies, right? So if this looks daunting, again, it's really not rocket science. Maybe the calculations sometimes are a bit tricky and difficult, but you just need to know how the indicator works and how you can use it to your advantage. But this is the advanced source. So for the people that, we're looking for some indicators maybe, and I'm going to discourage that in a second. Well, not necessarily discourage, but this is a good library to start from. Okay, this is a chart, but first I want to give you a little bit of perspective about all this stuff. I mentioned already price action is absolutely king or queen, whatever you want to use. Without price, you do not have indicators and you do not have patterns, right? But the other way around, yes. So, sorry, what I mean with that, like price is absolutely leading. Once price disappears, you don't have any indicators and you don't have any patterns. So indicators and patterns are derived from price. They are a derivative, right? They are sort of secondary. So that means that the closer you get to the source, and in this case, you can call that truth, if you will, the closer you get to truth, to the source, the better information you're going to be getting, and the more direct information you're actually going to have. So, and I hope I'm going, and maybe this is too advanced already, but if you really study price, so we'll look at it in a second. You will start to create these patterns in your head yourselves. You will start to see price behave in a certain way around certain price levels, and you don't need to draw any lines or patterns on your chart anymore. And you don't necessarily need an indicator that tells you X, Y, Z. It just shows you like, hey, price is behaving in this way. I can see buyer stepping in. And then you could incorporate volume, for example, but that can lead you to making decisions. As I mentioned before, probably you go from zero experience, then we have to learn all this stuff about patterns, how they're painted, etc., indicators that we can use, and I definitely encourage to use them. Try out as many indicators as possible, try out as many patterns as possible, and then ultimately you'll come to find that without price, none of that is relevant, so you need to get a grip of really price, right? Because if one day, I don't know, your indicator software component doesn't work, but there's a good trading opportunity, like, you don't want to have sort of like this confirmation of like, yeah, but my indicator, didn't indicate yet or something like that. No, price will tell you everything ultimately. So I hope that is clear, that all of that stuff is derived from price, and price is not derived from indicators and patterns. Okay. To a chart, and let's see if we can. So we have the support and resistance, indicators and patterns. Let's just draw some up. We can start with already. You can find this in the those were indicators that I just removed, you can find already what we do is basically we have like a resistance line over here, right? We can draw it like this. This is very rough. And then we have a diagonal line over here, and that you can see is what we call an ascending triangle. Generally speaking, these are seen as bullish. So the probability for price when it's in this, that it breaks to the upside, is higher than the probability that it breaks to the downside. And that's sort of how you can look at these patterns. But again, try to let go of the status of it being static. That, you know, okay, I see an ascending triangle, I'm going all in. You know, no, not necessarily. Just take it into your analysis. Like, hey, yeah, okay, cool, we're in an ascending triangle, but I still want to see some more information or confirmation that, you know, confirms that this is actually, you know, a bullish market and that we're going up. Perhaps maybe trend line is actually even better to start with. But I think that is clear. Anyway, so yeah, trend determination. We use these tools to, you know, to establish like uptrends, if you will. I don't know how you want to draw this one. I do use it quite a lot actually, but I don't put too much, you know, like faith in them, or I don't. Yeah, I incorporate it sometimes just to as an extra confirmation. But you can, your eyes will see that this is an uptrend, right? You don't need to really draw this line. So what I'm trying to say here is that if you depend on these lines, then once a circumstance sort of like changes and it invalidates your line, or it breaks your line, but it breaks your line in a place that actually just tells you like, no, we're going up further, then you may close your positions, or you may take a short position while actually, you know, it wasn't at all necessary. So yes, you can draw like your trend lines and stuff like that, and there are certain rules attached to them, but just ultimately also know that you just want to, you know, study price. I'm going to keep repeating that probably, but yeah. Let's see if we can find something else. So here's the ascending triangle again, right? Just over here. Just gonna see, like, show you also that for different, even though they're different assets, different markets, it's human behavior and it's supply and demand painting these pictures. And because it's human behavior at the background and emotion, as I said, so very negative emotion, if you will, panic to the downside over here, and like very like rational exuberance perhaps at the top, right? That is just human emotion that it goes completely crazy when buying an asset or when selling an asset, and that paints a certain picture. And for that reason, this stuff works on probably any asset that has a price history attached to it, where we can actually use a technical chart, at least within, let's just stay within financial markets. This stuff works. So this, let's keep working with the ascending triangle. I painted one a while back over here. So we're looking at the monthly. Here we see it happen again, where you have an ascending triangle, right? And you can see that 3 times that we saw it on a high time frame, it broke to the upside already. So you could then extract this information like saying, okay, when price does this, so we have a certain price ceiling at 1360 something over here, but every time we get there, sellers take over, but they don't take over to such a degree that we actually, you know, go lower than this price level, for example. So the trend is sort of shifting over here, and you can see that ultimately it breaks to the upside. And there's just really many examples. So this is gold. We've done stocks, we've done commodities. Let's look at Bitcoin for a second. We need to switch to a slightly lower time frame, but there was a very famous one over here as well, where you can see an ascending triangle pattern. So take it with some salt, but do know that that is something to look out for when looking at price. The opposite side is also true. So we have an ascending triangle, but we also have a descending triangle. Probably the most famous one was this one over here. And then the likelihood is stronger that it breaks to the downside. Okay. And the same happened roughly over here, like a descending triangle, and it broke to the downside. Okay. Sometimes we have symmetrical triangles. So this was a very good example in my opinion. So we had something over here. But the rule generally is like if we come from a like the uptrend was, the trend previously was up, then this is slightly more higher probability that it's symmetrical triangle. So it could either go up or down. There's a slightly higher probability that we continue further upwards. Okay. If I'm going too fast, well, we always have the rewatch functionality, right? So that's that. So we have trend lines. I will talk a little bit more about trend, how that works in corporation with Market structure, probably next video. Yeah, I think that's okay. Anyway, so this is how we can look at patterns. Indicators tell you something. So let's just work with, let's stick with one. This indicator over here is what we call the relative strength indicator, or the RSI. And this can tell you something about, there's a couple of things. We have the 30 and the 70 line over here. And we very simplistically put, we can say when this line goes above 70, it means a couple of things. It means that there's strength in the market, but it can also mean that we're approaching levels where, okay, an asset is overbought, we say. And that means that there's just this irrational exuberance coming in where there's just a complete buying frenzy. And this has deviated so much from the mean that it has gotten to an extreme point, and we should be careful, right? So, and you can see that as we enter this area on the indicator over here, we can see that that also aligns a little bit with price. There's much more to this structure, right? We can see over here, and then ultimately price sort of goes down, the indicator goes down, etc. But before I get too deep on this, because there's already inherent in this structure over here, there's some information that tells you that you can get out of this asset. Yeah, so I think that's it. So that's an indicator. Moving averages. So see if I have some on. I don't think so. Moving average. There's a moving average simple. Let's put 2. We put 2 on our charts. Explain you later why. And we put one metric. You don't need to understand what I'm doing right here. I'm just going to point you to what a moving average does. So let me remove the drawings, remove the indicator. Now all of a sudden we see 2 lines plotted on our chart. And one thing that I've selected is a 50 moving average, and one thing that I selected is a 100 moving average. And it takes the 50 moving average takes the average price of the last 50 trading periods. So the last 50 candles, the average of that sort of gets depicted in a line. And we also have like a longer period of time. We have a double that, like 100 trading periods before it. Now, what is interesting about that is if we do this, we can, for example, say if price is above a certain moving average, in this case it's above both, then we are bullish and we can, buy the asset, and until it goes to the downside, maybe then we can sell, which it did over here. So that already you can see some sort of strategy in which if you bought over here and if the actual time that it broke down over here, you can say like, well, let's say that you bought the average over here and you sold the average over there. That's a 321% increase in this case. I'm not, there's a good chance that you would have sold here, but anyway, that is very simplistically put a potential strategy for this stuff. Okay, I think this is also explained in the sources, but I just want to show you a simple example. Is there anything else to cover? Let me just quickly peek. Yeah, no, just some perspective, I would say. Yes, like this. So price is absolutely leading, and I would say the closest or the best way to monitor price is via candlesticks, because that just tells you like within a certain trading range, whether that's 5 minutes or like a day. Let's go back to the chart. One thing I wanted to show you about price action, by the way. Sorry for the chaotic video. Not sorry. It's just it's the way it is. Sometimes it goes like this. Let's say that we have Bitcoin. We can also switch the time frame if you've got a paid version of TradingView, where every candle represents 10 seconds. Or let's take with you can go completely crazy, but let's stay with the 1 minute. And here you can see price actually, it paints every minute, it paints a candle, and you can kind of see the same thing happening. These patterns are shaped on all sorts of time frames. So I don't know, you can, for example, work with trend lines over here that you say, okay, if we break this trend line, potentially we go further down. We also have this moving average thing over here. Remember confluence. That's sort of like how we want to start looking at this game. But studying this, and this is what I did a lot personally. So staring at the 1 minute or the 5 minute or the 15-minute time frame, and based on those time frames, trying to understand how is price behaving. So why, for example, does this happen? Like, how does this happen? We are sort of like ranging between a couple of levels. Let's Option or Control H, horizontal line, and we can work kind of. Let's work a little bit further into the past. We have kind of this area. Let's take this low. Oops. We have this. Whoops. I just really messed something up. I'm not sure what is happening here. There we go. It's back, right? Okay. Option H. There we are. Let me just check if I'm still... yeah, okay, cool. So we can work with, let's take this one. Price is fluctuating between low, high, etc. And all of a sudden it breaks down here. This is a very rough sketch, but all of a sudden it breaks down here. Buyers step in and it's pushed all the way back up, and consequently it's going to this high. There are obviously people selling here, right? Like, what makes them sell over here, and how can we anticipate their selling and actually turn into a buyer, right? And we're talking about short-term price movements, but the difference between this low area, let's take it roughly, and this high area is 5%. That's quite a lot. And we're looking at every candle being 5 minutes in this case. But this happened in a period of, this is now the 4 hour that we're looking at. I will try to keep it cleaner in the future, but it's a very short, this is like, what, a day trading, right? So day trading. And this is like a 5% move in here. And this is the game that generally short-term traders play with technical analysis to try to catch these moves. So rather than zooming all the way out and trying to ride these 300% waves, we're looking at shorter-term time frame movements to make analysis. Okay, I think that's way more perspective maybe than already necessary, but that's some beginner concept of at least how to look at it. You don't necessarily need to be able to do this right now, but just understand that this is the methodology of technical analysis. And as I said, deeper and deeper. But that's so supply and demand, price action is important. Price leaves a picture. We can analyze that picture and we can use it to our advantage to say like, okay, this is the time when people are really selling. I need to get out. And yeah, this way of looking at an asset, it just really, as we say, works. And I just know from experience that you can benefit from this hugely, really. Okay, I think that's it for beginner concepts. Probably this was a bit too deep maybe, but I think you guys are all intelligent, so otherwise you wouldn't be here. Right, you will get it, and you will really get it down in the end of this week, and also with the lectures. And of course, we're always there to help you with questions. And as you notice, I really love talking about this topic, so I don't care how many questions you ask me, we'll get it clear in the end, and I will not stop until everything is clear for you guys. Okay, see you in the next one.